we're bringing you all you need to succeed in the real estate business. It's Spilling the LTea, brought to you by Lawyers Title, telling you what it's really like to work in real estate.
Welcome back to another episode. I'm your host, Tamera. Today, we're going to talk about how investors can continue to invest in this particular real estate market. But first, if you like my content, you're really going to love my escrow team. So I hope you'll give me an opportunity to talk to you about your title needs. You can reach out to me on all of my social media platforms and let's get a conversation going. Today's guest is Mike Hansen. He is the co-founder and CSO of ZHS Investments. I can't believe I just rolled that one off. And he is a very valued partner of mine. He has a lot of expertise in the investment market, wholesaling, flipping. So I know that we're going to have a really good conversation today. Welcome back to the show. This is your second time, Mike.
Thank you. I appreciate you having me back on.
You're awesome. I'm so excited to have you here because, we've been at meetings before and you are an incredible wealth of information. And I'll tell you the one time that it really hit me how much you care about research and making sure that you guys are doing good business. This was when all the creative financing stuff started. And I was like, what's a novation deal? What's a this deal? What's a that deal? Yep. Because we all see lending trends depending on the market, right? Yep. And so a lot of the, investors and wholesalers in your world had to get creative when money started getting really expensive, right?
Yeah, absolutely.
So we started to see seller financing deals and some of these other creative financing deals. And so I didn't have a clue as to what those were. And I'm happy to be vulnerable about that. Right. And you had done an extensive amount of research, the pros and cons of each type of creative financing deal. And so that really impressed me and stayed with me.
Well, thank you.
I hope you know that.
Yeah, thank you.
So let's kind of talk about where we're at right now. Okay. We are in July of 2023. They just raised interest rates again. Yay. And so we're seeing a slowdown and we know why. Money's too expensive. There's not enough meat on the bone in deals. So let's kind of break that apart right now. And so I guess my first question is, how are you guys finding, because you're still rolling down the road.
Yeah.
So can you share with me how you guys are finding and analyzing deals and are able to find ones that fit within your parameters to go ahead and go under contract on?
Yeah, absolutely. I think you hit the nail on the head. Money has gotten crazy expensive compared to what we're used to recently in the last 5 years, right? It was almost free. Even on the investment side, it was, for long-term rentals, you could get a 30-year fix for, anywhere from 3.75 to 4.5%. So even the rental market was amazing if you didn't want to fix and flip. Sorry. So it really makes you have to put your ego down and realize, hey, you know what? I might not love buying from wholesalers, and I say that, as a wholesaler, because I got in the business just wholesaling. That's how I started out and learning how to fix and flip. And I see a lot of when money was less expensive, I saw a lot of fix and flippers who just hated buying from wholesalers. And I think part of that came from they would see a fee a wholesaler made on a certain property if they made a home run fee on a property, not really realizing how many properties they maybe only made $2,500 or $5,000 on.
Right.
There's a lot of overhead that goes into that side. So on my behalf as a wholesaler and other wholesalers, as fix and flippers, you've got to realize, like, if your math works, who cares where the property comes from?
Right.
Did you get it at the foreclosure auction? Did you buy it from an agent off MLS? Did you buy it from a wholesaler? Who cares if the math works? So that was one thing I just really realized early on is you've got to put the emotional side of part of it and stick to the math, So we just went back and realized explaining why our offer is our offer to agents, because we get deals through agents too, that they're still going to get paid. We insist on the agents getting paid. If the seller can't take care of them, we'll take care of them. But why our offer is what it is, and we don't have any problem being transparent with the numbers. If it's a more expensive property, our spread has to be bigger because the cost of money's higher.
Yeah.
And if it's a $500,000 property and you're going to put $100,000 into it, your loan's going to cost you minimum $6,000 a month in holding costs, and it's probably going to take you 120 days from close to close. So you've already got 4 months. So you've got $25,000 just in holding costs.
Whew.
And that's just for your money person. That doesn't include taxes,
all the rest of it.
Taxes, utilities, insurance, your exit costs for commissions when you list the property and sell it. So it just takes bigger chunks of cash to do a more expensive property.
Yeah.
So we used to do almost exclusively, $500,000 and up listing prices.
I remember.
So we had to make a pivot to, really stuff that was $350,000 and less, because your buyer's pool is like so much bigger. If you've got now $1 million house, your buyer pool just does this.
Well, anything luxury, unfortunately, just isn't moving right now.
Yeah.
The luxury market is dead.
It's tough.
I want it to come back so bad.
Don't we all?
But, that's a really big golden nugget that you said. One that you guys have had to pivot, move into lesser price points.
Yep.
Because so that you can offload the property quicker.
Yep. Yeah, that way your holding costs don't kill you. People don't realize you hold on to that thing next for 3 or 4 months. That's a big chunk of your profit. So even on stuff that's 350 and lower, we really looked at, hey, if my price point, if I'm buying for me and my family and I'm out there searching for houses and I have $350,000 that I'm approved for, would I feel good moving my family to that neighborhood? If we can say yes, we would buy it as long as the math worked. And we've jumped back up now into some of the more moderate ranges, anywhere from 375 to
500,
600. 600 is really our comfort cap, unless it's Canyon Creek and Richardson, or areas of Frisco or Plano where it's still moving really, really fast, but it's very micro pocket specific for what neighborhoods we'll buy in if it's above that $350,000 or $400,000 listing price when we're done fixing it up. So,
well, and this is a little off topic, but I'm going to back up to something you just briefly tapped into.
Okay.
You said that if you look for houses because people need places to live, and that 350 price point is an affordable price point for Texans.
Yep.
And it's starting to tap into something, and this is also kind of backing up because you said wholesalers have a bad rap. I want to be very clear about wholesaling, right?
Yeah.
We lawyer's title, me, have a pretty good experience now with wholesale investors. And it is very unfortunate, but there are wholesalers out there doing really bad business.
Yeah, I would agree with that.
And what people need to understand is there is a place for wholesaling in the market. There are
100%.
houses that are not fit for MLS. The sellers are distressed. They need to get out of their house quickly. They don't have the money to rehab it. Like, there's all these reasons why wholesaling is necessary.
Agreed.
But what you need to understand about ZHS, and I've got a couple of other ones, is, and I sat in a room with Sean and Kyle, not too long ago, of them talking about this.
Yep.
The care that you give your sellers, and I'm talking about explaining exactly what's going to happen. That is huge. We have a lot of people who try to wholesale a deal and the seller has no idea what they've actually signed on for.
Right.
Okay. And so having the care that you have with just people in general, you guys are just good guys.
Well, thank you.
I got an email from one of your people about a whole campaign for school supplies and backpacks for underprivileged, right? Yeah. And so it's things like that. You have to understand, not all wholesalers are doing bad business.
No,
there
not at all.
are wholesalers out there wanting to help people and also have a successful business, and there's nothing wrong with that.
No, I think you hit the nail on the head. It's and thank you for the kind words, by the way. I've been super blessed to have Kyle and Sean are my business partners, by the way, for anybody who doesn't know that. Amazing business partners who truly care about people. And yes, we want to make a profit. We're in the business to make money. But we can, a rising tide raises all ships. If everybody in the deal can make money, including your sellers, it's a win for everybody.
It is.
And I think the part that really sticks out for me is if you go into it with a solution mindset of how do I help my seller who's got a unique situation, a problem, how do I help them fix that problem? Mm-hmm. Maybe the best option is still to list it on MLS. Maybe it's not a cash offer from a wholesaler. But when you can go through the list and say, hey, this is what I think your house would list for in the as-is condition. This is what I think if you put, a certain amount of money and did the repairs, here's what the comps look like. Mm-hmm. When you can do that and walk them through the whole process, it makes it better for everybody. Yeah. And then if you're like, hey, the goal is to get to the closing table, right? So if you're the wholesaler and the only thing is that you're just trying to make the biggest amount of money possible, are you really doing the best service for the seller? If you can help your seller move, if you can get them set up in another place, if you can put a little extra money in their pocket so they can get a fresh start and you can still make good money, awesome. and as long as you go into it with that mindset of helping the seller out, and sometimes our seller is the wholesaler, right? So if we can help the wholesaler get the deal across the finish line, if we're the end buyer, that's a win too. But I think, what helps set us apart is we don't just put every house under contract.
Correct.
Just to try to get a contract.
Correct.
If your KPI or key performance indicator as a wholesaler is just number of contracts, you're kind of a little misguided. It should be number of contracts you can actually close or have
magic word, magic to my ear.
Have a very high, very high percentage likelihood that you can get that deal closed. I mean, sometimes you get to the house and it's like nothing you expected. But for the most part, if you're putting it under contract, you should be 95% positive you're closing on that deal.
Well, and I'm not trying to throw anybody under the bus here. So
no, me neither. There's some great wholesalers besides us.
What I'm about to say may sound like I'm trying to throw somebody under the bus.
Noted.
And I want to be very clear. I'm not trying to throw anybody under the bus here. But I think a good indicator of a good wholesale company is a huge pool or database of people that can buy the property.
Yeah.
Okay. So, for example, a wholesaler that's trying to wholesale and doesn't have an end buyers list, the likelihood of their transaction closing drops. And I have history in this. So I'm 80% termination rate.
Yeah. That unfortunately, I think they probably go into it with great intentions of trying to get it closed. I'm not saying like wholesalers are out there trying to do bad business. I don't think that at all.
In this particular instance, it's not that. It's just they don't have resources.
They don't have the resources. And I think the other part where it trips up a lot of wholesalers, if they've never done rental properties or they've never done fix and flips themselves, or been a part of a team who does, where they can learn from that, they don't realize like inflation might say it's 7 or 8%. But on a lot of the cost of goods, real inflation is 20, 30, 40%.
Yeah.
Rehabs that used to cost us $40,000 are costing us $65,000. So the old formulas of, ARV times this minus this don't work if you haven't adjusted for the cost of labor and the actual cost of goods.
That is very important what you just said.
Yeah. And I think that gives us
used to take you cost 40,000, now it costs 65.
Yep. Yeah. And I think, if you can't treat wholesaling like a job. You have to treat it like a career, and it should be constant learning of researching, asking flippers, what are their costs? Well, how much does it actually cost to do a house like this right now? So that you can run accurate numbers, because that helps you gain credibility as a wholesaler. It's what's helped us gain a great reputation over the last half decade that we've been doing it. Is our numbers are usually very, very accurate. We run it past realtors, we run it past lenders, and we lend. And we still run it past other lenders, and we're constantly asking questions. We're constantly learning the business from other people, so that we can have accurate numbers. So it helps you gain credibility, but it also helps you help your seller. And if you're doing it with a solution mindset with your seller, it helps them because you can give them an accurate number and not have to back out of the contract the last day of option or the day before closing, because all of a sudden there's no buyers available.
Right.
So, and if you're a newer wholesaler, we don't do actual mentorships with people right now. We've batted it around a little bit. I don't love the idea of 50 people in the class that you've charged $25,000. That works for some people. For me, I like more of the one-on-one stuff. Yeah. I'm always happy to answer a few questions. I can't just bring you in as a full mentee, and give you all the secrets of the business. But if you got a few questions on how to help, if you need help selling a property, we do help other wholesalers sell properties too. Our goal is to the more people that do the business the right way, the wheel keeps spinning for everybody, and we can help a lot more. Yeah, and we can help, and you can help a lot more people.
You can help a lot more people, and what is a consistent underlying vein of what you're talking about today is service. Yeah, service to others, right? And so I think that there is a place for wholesaling. And I think that I'm very appreciative that we had this part of the conversation, because it helps others learn that not all wholesalers are bad.
No. And there's a lot of great wholesalers out there. We don't have a monopoly on the market of being good wholesalers. There's other great companies that we do business with too.
Yeah, I'm actually very blessed to have a couple of, have some of you guys that are just really good people doing really good business. And so I'm personally very blessed that you guys continue to partner with us. So thank you for that.
You've been a great partner in business too. I mean, the fact of our side of the business is one point, right? But once you get it to a title company, if the title company doesn't understand the investment side of it, because it's a parallel universe to the retail side. You know, it's I forgot who told me that, but they said people they know how to live, but they don't know how to die. Meaning
you are not wrong.
Yeah, you know, there's
they're not
always
set up. How many people don't have wills, don't have any estate planning, there's all kinds of issues on title because there's all these people that, you know, have a right to the property that aren't even with us anymore, you know, so people don't, unfortunately understand that they need to set this up.
Yeah, and if you get to the wrong title company that doesn't understand that side of the business, and these can't drag out for years. And I've had ones that have drug out for, I think the first deal I ever did took 18 months to close.
Stop it.
Well, there was like 23 literal heirs. 2 were in prison, 1 for capital murder. Like true story.
I've heard these stories before.
I wish I was making it up for a fact, but that is a true story. Yeah. And I never thought it was going to close, and it ended up closing. But, you know, a title company that can understand the investment side of it, and time is still of the essence on these deals, but also understands that it's more than just, you know, there's more types of ways to get a deal across the finish line than just your old school double close or an assignment. You know, there's multiple ways to help everybody to still get the deal across legally, and ethically, and still have an insurable title. So it's you guys have been a great partner in business too. So
thank you very much. Let's kind of move on. Did we address how you guys are finding deals?
A little bit, you know, just a quick recap. We still buy from other wholesalers. We do direct mail campaigns. We have realtor referrals. We search MLS. We have a full acquisitions team in-house that does, you know, text messages and things like that. So there's multiple ways to do it. It's just, you just have to be so much more due diligence goes on the front side in terms of what's my realistic list price when I'm done, or ARV for investors out there who know the lingo. What's my realistic ARV that I can prove on paper? When the market was crazy and everything was going way over, we even got guilty of it a couple times. Be like, well, I know it's paper says it's this amount, but I know it's going to sell for this, so we do the deal. You just can't do that anymore. It has to be what can you prove on paper.
Yep.
And, you know, and for wholesalers putting deals out, you can't continue to say, hey, I think my gut tells me this. Well, my gut tells me that too. But when I go to a lender, I got to say, this is what I know it'll sell for.
Sure.
Worst case scenario, I can exit at this price. If I even take a little bit off and the deal still works, then it's probably a safe deal that a lender will lend on and that you can get across the finish line. So.
Okay. So I think, you know, while a lot of people are taking a pause, did you say pencils down right now? Was that you? Because I just did it.
I've heard people say that. Yeah, I've heard people say that. I did another
podcast recording yesterday with another wholesaler. So there might be like the conversations are going to run into each other. He was like, yeah, a lot of investors are pencils down right now. I'm like, yeah, that's a good term for it. But I think there's still, you know, and I've taken a pause as an investor. I've got some other things that I'm working on, right? And so this taps into the next thing that I want to talk to you about. If you are not able to actively buy and sell property right now because because what we have already said is this is a referral network.
Yeah.
This is a network of referrals, right? And so this stuff isn't like traditional real estate, and it's all built on a community of people that network and refer business back and forth to each other. So it may be hard for an investor that's outside of real estate, you know, just an individual investor to find a deal right now.
Yeah.
So there's alternative ways that you can continue to invest and grow your money that aren't the stock market, right?
Correct.
So let's talk about your capital fund, and because I want to tap into, we have like 3 line item things here that you guys do for passive income.
Yeah.
Okay. And so a lot of people, while they want to sit on the sidelines from actively being an investor, they can still invest their money in passive income streams and still be able to capitalize, right?
Yeah.
So let's start with the long-term capital fund.
Yeah. So our Titan Real Estate Capital Fund is more geared towards your long-term passive investor who doesn't need to have liquidity right away.
Right.
So what that allows us to do, it's really a 3 to 5 year exit plan. They could exit sooner, but to get the most on their money, really you'd want to be able to set that money aside for 3 to 5 years and say, I don't need to touch it. I just want to make money on my money.
And most of the terms I hear about are 5 years.
Yeah. So,
even a little bit longer, 5 to 7.
Yeah. We have our goal is 3, but on the PPM, it is up to 5 year for the exit. Now, because that allows us, so it's set up where the investor at the front side makes 75% of the money, and we only make 25% of the money up until a certain return on investment. And then when they get to that point of they get the 100% of their investment, the 8% preferred, and then they get up to, I think it's, don't quote me on this, 16 or 18%. Once it gets to that on their investment, then it flips to where we get 75% and they still get a 25% drip on top of that.
Well, let's back up for a second because so initially you make an initial investment.
Yep.
All of these capital funds have a minimum investment amount.
Yep.
Typically I hear somewhere between 50 and 100,000.
Yep. Ours is 50.
Okay.
Yep.
So the investor will give you $50,000.
Yep.
And then you...
It goes into the fund. It's a fully regulated fund, if I can talk. So it is registered with SEC. Michael and John both were Wall Street professionals for a long time. Michael ran the Royal Bank of Canada's investment fund, a $1 billion fund. So they are the ones who actually put all the legalities and protections for our investors in place. So it's a very, very protected fund. It's a very safe fund. So, I mean, obviously there's always risk involved, but there's a ton of protections built in for the investor. So when we get that investment, it pulls in with another larger group of investors.
Correct. Yes.
So the goal is to get to $20 million, and then we can go out and buy turnkey rentals, fix and flips. It gives us a little more flexibility. So if we've got 20 houses going at one time and say we're capped out with our properties, we could turn one into a rental for the next 1 to 3 years, wait for the market to continue to appreciate, and then exit at that point. And all that money goes into the fund.
And that's a little bit different than what I have normally or historically heard about capital funds, because most of them take the money and go buy a large multifamily product with it. So you guys are a little bit differently diverse in the portfolio holdings than what I normally hear about.
We'll do some single family. We'll do some multifamily. It can be used for leverage for the multifamily if we've got other debt secured for the multifamily. So we can get really... I don't want to call it creative because that sounds kind of scary.
Yeah.
But we
diverse.
Diverse is definitely a better word. Really diverse way of doing it. So the main goal is to do fix and flips first. So you're getting big chunks of money back into the fund right away.
Okay.
Or, unfortunately, I think we're going to see a lot of newer build houses start to hit the market where people just got in trouble.
That's happening in my neighborhood.
Yeah. So,
they all want to lease. And I'm like,
unfortunately, America's always been beat the Jones, right? So you always want the best house, and people were maxing their budget for a long time. And so if they had $300 to $500 a month in disposable income, that's gotten eaten up on gas, groceries, just the cost of living. So people would start to put bills on credit cards, and then now all of a sudden the credit card's maxed out. What starts to go? Do you file bankruptcy? Do you go late on your house payments? Do you just sell the house and downsize? So unfortunately, I think there's going to be a lot of 2000 and up builds that do hit the market that make great turnkey rentals.
I agree,
and I think as an investor, it's a great time to buy those. So if you're looking for a passive income, if you can get into a fund, whether it's our fund or somebody else's fund, where you're protected by volume.
Yep.
And that's what makes the fund so secure and less risk adverse for a lot of passive investors, because you'll have hundreds of houses in there. So if one doesn't make money, you've got 199 other houses. If you got,
I actually really like that a lot because, like I said, most of the ones I've heard about buy large multifamily product.
Yep.
Now there is some risk aversion in the multifamily because the one tenant leaves, who cares, right? Yep. There's 300 units or whatever.
And you can refinance that every 3 to 5 years. But if you're trying to run that, if you're trying to buy a multifamily now on appreciation, that's a little bit risky. Like it's got to make money now.
Yeah.
While you're rehabbing it and forcing the appreciation, because depending on where the market goes, on who you ask, there might be a small dip in the multifamily. There's not a lot of multifamily available right now.
There's not. It's very high. It gets gobbled up. Yep. So I like the fact that your portfolio is diverse, so that if something doesn't work, it's not tanking the entire portfolio. Correct. So what can an investor expect as far as their returns?
They should expect...
Are they getting monthly mailbox money? Or
no, I think it's set up to be able to do it quarterly, but if there's not enough returns in the quarterly, we do it every year. They get their dividend. It's 8% preferred return. Okay. And then at anything above that, I think it's at like 18 to 20%. Then once they get that in their initial investment back, then we can flip the fund to where we actually make a little bit more money on it too. So
okay. And so then they can exit out either somewhere between the 3 year, or is it 3 or 5 year?
There is a minimum 1 year. If they want to pull out before that, like family crisis type stuff, they might not make any money on their money. Got it. It depends on what's going on in the fund, right? If we've got a lot of capital invested in fix and flips, and there's not a lot of single family rentals or small multifamily in there that's generating the passive income, it just takes a little while to build up the returns in the fund. So that's why you see most of them that are long term.
Yeah.
Because you're trying to build volume into the fund.
Okay.
So normally the goal is 3 years.
Okay.
So minimum 3 year. We would like it to go to 5 because then that allows us to obviously make a little bit of money for the work too. So
sure. Okay, so that's an option, and then we talked about one-off JV deals.
Mm-hmm.
So you want to expand on that? That's a shorter term.
So there's shorter term for the investor who wants a little more liquidity and wants to get a higher return. So for an example, there's a couple ways we can structure it. We have a couple of private money investors. They fund 100% of the purchase, 100% of the rehab. There's no interest. There's no points. So it helps us in case the property sits on the market for a month or two longer. We don't get eaten up in holding costs.
Okay.
But we're still super conservative of what we buy. So our goal is max 120 days closing to closing. Buy it, close on it. We exit at 120 days.
Okay.
So that allows the investor, really, we're shooting for 90 days so we can turn the investor's money over 4 times.
Got it.
So for an example, one of our investors did that, and they made $28,000 on their initial investment of $25,000. So sounds pretty good, right?
Yeah.
But they got the hard money loan. They did all of that stuff. So the house was technically in their name. We did all the work, split up the profits ahead of time. So they knew what to expect.
Yep.
And we could make some money on it too. We're great guys, but we're not a charity. We have to make money.
We all have to make money.
So if we can turn that 4 times, now they've made $100,000 on their $25,000 investment.
Okay.
But there is more risk involved because it's tied up into one house. Now they get first lien position. They get all of that, right? So there is some protection if the business went sideways, God forbid, anything happened crazy, and we buy at such a discounted rate that they should be able to at least sell the house and get their money back.
Okay.
But it is a little more risky because there's only one property, so you don't have your funds diversified like the big fund,
right?
Where you've got hundreds of properties.
Right.
If one goes sideways, you run into stuff that's completely out of your control, and you just don't make money on it. You're protected longer term in the big fund, so that's for your less. The big fund's great for people who just want to be able to sleep better at night. Yep.
Yeah.
The one-off deals are nice because that allows them to turn the money faster, and they get
more sexy.
A lot more sexy, right? So if I can make $100,000 on a $25,000 investment, and it's secured by real estate, that's a hell of a deal. So generally, that takes one of two things. You either need to have a bigger chunk of money available so you can do the entire purchase price and rehab, or the ability to qualify through a hard money lender, and then you just make up that difference.
Okay.
So like if a hard money lender is going to give you 80% of the purchase and rehab, or 80% of loan to value, there's 20% that investor is still going to be on the hook for to come out of pocket to be able to do the draws and the rehab and in that instance. So you've got to either qualify with a hard money lender, home line credit, or if you've got some retirement funds that you want to borrow against, one of our investors borrows against the stocks to do that because, he's making 18% on every single property, and he's turning that money over multiple times, and he's making he's down in the stock market right now, so he's making way more money than he would if he had the money in the stock market, and it's secured by an actual tangible asset.
Right. So. Okay, and do we?
And then there's one more.
I don't want to run out of time here.
No, I'll make it fast.
Small portfolio packages.
Yes, there's actually 2 more then. So there's small portfolio package. So let's say, Tamera, you got 4 or 5 friends that can put together $1 million. We can do, it's almost called like a mini fund. So we'll buy 4 or 5 houses. How many houses we can ever buy for that $1 million?
Right.
And then turn that as much as possible. And that's a 1-year commitment on that. So that allows you to get a little more volume in there, a little less risk because you have a few more houses on there.
Sure.
But it is a little bit bigger financial commitment as well. And then the kind of like the hybrid would be, let's say you've got $50,000 you want to invest. So we'll go get a loan in our name or use our money sources on a flip that we're going to do. And you want to do that $50,000 micro loan against a property. So then you get second lien position on the house. And it's basically covering the rehab, the points cost for us. So we don't have all the holding costs.
Okay.
And then you make a percentage of the actual net profit as well. So there's a couple different ways to do it. And it's always secured by the real estate. So
That is really cool because I've had a lot of conversations with investors that just aren't comfortable on their own right now.
Well, there's the comfort level, and then sometimes you just don't have the know-how or the time.
Correct.
Because it's not like on HGTV where you can just do it on the weekends. You're gonna be in the house for a year.
Yep.
And then you don't make any money. So the first example I said where they made the $28,000 or $25,000 on their initial investment. They both work full time. One's a nurse and one's a cop, and they have no time to do it, and they don't want to learn how to do it. So like, we know you, we trust you, we've seen your track record. How do we get involved so we can just make our money grow a lot faster? Mm-hmm. Their goal was to pay off their current house and their new construction house they just moved into in the next 5 years. So very achievable to do both if they can continue to make $25,000, $30,000, $40,000 clips on their money.
Well, and I'm very much a person that likes to write a check instead of DIY.
A lot of people are like that. I love the process. Yeah. Not everybody does.
Well, you're doing it every day. Yeah. I've got a whole nother job I got to do.
My eyes light up when I get to go in and demo a kitchen and a master bathroom.
Oh, I see your videos on social. Yeah. So, okay, before we wrap up, again, I want to make sure that we don't go too far over time today, but I wanted to talk about your hard money company really briefly because there are a lot of options for hard money out there. Yep. However, I want to hear what you guys are doing because this is a new endeavor, new to me, knowing about endeavor. So do you want to talk about the hard money company for just a second?
Yeah. And it's kind of, so we do traditional retail lending too. We actually have a normal mortgage branch. Okay. And then we have kind of a hybrid product that not a lot of other people have out there. It's similar to, if you know what the FHA 203K loan is.
The construction.
Where you're allowed to have some construction in there. We have a similar loan without all of the hoops to jump through. Okay. Where they can actually pick one of the houses that we're working on, buy it at what we would list it at, and it would be based on comps. And it covers the entire ZHS approved rehab. So they'll get a beautiful house, no bidding wars, no driving around DFW for weekends and months on end trying to find a house that just gets sold or settling for one that needs a lot of updating. So that's kind of a cool way they can get a ZHS fully rehabbed house, get the loan qualified right away, and they don't have to go through all the bidding wars and all the other stuff. They say, I love that house. This is this or that. We're not going to give them a million options in terms of finish out. We have finish outs that we go with. So that's one. And then we have the hard money loans that will be available very shortly. Okay. So what we learned in the business is there was this or that type of option. You either had hard money lenders that were super easy to work with, very easy process, but a little more expensive, especially on points and interest. Or they would throw in a bunch of like origination fees, junk fees, drop fees, all that stuff. Or you had guys and gals that were in companies that were very low rates, very low points, but they would still hit you with a lot of the extra junk fees. And you had to have appraisals, you had to do surveys, and it was this really long process. And to get your draws, it just seemed to take forever, and you had to jump through a million hoops.
That's more holding costs.
Yeah. So exactly. So we just tried to, if those two had a baby, what would it look like? You know? So we really want to make it super easy. So we do a desk appraisal. Okay. So I don't have to drive out there and look at the property. Yeah. You know, we run comps on everything. If I got questions, we got some great realtor partners that will look at it too. Okay. Most of the time, it probably won't need a survey, especially if it's in an established neighborhood, things like that, where you're not going to run into a lot of issues. Like real stuff and land would definitely require a survey. But and then lower points and lower interest and none of the junk fees. Okay. So, and most of the time, if it's somebody that I've already done business with that's bought a lot of houses from our wholesale side, most of the time, all I need you to do is just FaceTime a video with me. Sure. Walk through the house so I can see the work's been done, and then we just send you the draw. Got it. So super easy. Yep. Okay. Now, if you're a first-time investor, it might be a little higher points or interest, and there might be some extra checks and balances in place. But that's the advantage of working with somebody who's in the industry too, and actually flips, because they say, hey, you're not going to get that ARV with that rehab budget. Here's what you're going to need to do. Or if I see the workmanship on something like, hey, you've got to redo that tile, or you can't use those cabinets in that house, you're never going to get the selling price that you're looking for. We can hopefully catch before they lose money and help them make money, because we make money if they keep coming back and borrowing, right? So we want to make sure they make money.
Everybody wants to make.
Yeah, right. And
there's nothing wrong with that.
We don't want to be in the business of just foreclose on a house. We don't, you know, that's
it's not good for everyone.
No, and it's a pain in the butt, to be honest, for everybody involved. So If we can help guide some of the newer investors, it's going to be a little more expensive at first, but then after you've done a couple, then you get the preferred, platinum level rate or whatever we want to term it. Where it's lower rates, lower interest, and hey, you can just FaceTime me, and so I see the work's done. And
one of the things that I've seen with hard money is they do have they require experience in flipping in order to qualify for hard money. So I'm an investor. Right. I own 6 stores. I would not qualify for hard money because I'm a buy and hold and not a flipper.
And if you did, it'd be very expensive.
It'd be very expensive. Yeah. So hence one of the reasons I've never done flipping. Well, that and that's back to the bandwidth issue. I can't.
Yeah, you're slightly busy.
Yeah, I'm a little bit busy. So anyway, this has been a very valuable conversation today. And so thank you for coming on the show. I really appreciate your character. Okay. That's super important. And your willingness to share.
Absolutely.
I think that just makes the world turn, right? And we're all going to keep partnering and doing good business together and moving down the road. So it has been an absolute pleasure to have you on the show today, Mike. Thank you.
Honored to be here. Thank you for having me again.
So that's another episode. Again, I'm your host, Tamera Gady. If you like my content, you're really going to love my escrow team. So reach out to me on all my social media platforms. Let's get a conversation going about your title needs and make it a great day.